Hey everyone, it's Simon here with another quick market update. Today is Saturday, the 21st of April. Sorry I've been quiet the last couple of weeks. I've done a bit of traveling. Thanks everyone for your well wishes. I successfully got my Jeet Kune Do instructor certificate in Thailand last week, so watch out. Anyway, back to the markets, and you may remember we've been talking about the prospect for a W bottom formation happening here. Now, this is the chart of the S&P 500 again, and looking at where we are now, it's still kind of in no man's land. You know, we had a brief close here above the 50% retracement, which is bullish, and then a close back below, and back in between the 50 and the 38.2 here, which, you know, it's a little bit bearish. Now, the things that are going for the bulls at the moment are every test of the 200-day moving average has proven safe. And not only that, we've actually managed to clear the other moving averages here as well. Although having said that, I am containing my enthusiasm there a bit because these moving averages are all now looking pretty flat. And flat moving average lines tend not to be respected by the market. However, I am still inclined to give further upside and this bull market the benefit of the doubt. And let me talk you through my reasoning here, why I still think we will see further upside into next week. Firstly, if we look at the Nasdaq, now I had thought the Nasdaq was going to be a laggard and the rest of the market would probably lead the Nasdaq back up. Looks like I was wrong there, and the Nasdaq is still leading. So what we've got here is on the triple Qs, we've got well, it hasn't even tested the 200-day moving average, but we've got a reclamation of the 61.8% retracement, and here we've even had a close very, very close to the 78.6. Now, if we get a close above this line, that means the market will target this high, and if we clear that high, it means the market will then challenge new all-time highs. So if we get a bit of strength early next week, then I think we could certainly see the Nasdaq and the triple Qs start to target this high here. Not surprisingly, same sort of picture is evident in the tech sector, where we've actually had a couple of closes above the 78.6% retracement, which definitely puts this high as our next target. And if that gets cleared, tech could certainly look to clear all-time highs again. The second thing I want to point out is the advanced decline line. This made a new high just recently, and it is looking in pretty good shape. So this is just a cumulative index of advancing issues minus declining issues. And if you see divergence in this line in the index, that's something to watch out for. So in other words, if the index is making new highs, the S&P 500 is making new highs, and the AD line isn't, that's a sign that the rally could be running out of steam. That's not what we're seeing here. In fact, we're seeing this line make new highs and the S&P 500 isn't making new highs. So that's actually, if anything, a positive divergence. So that's another tick for the bulls at this stage. The other thing that has caught my eye is the fact that your so-called safety trades, bonds and Japanese yen, are not rallying. In fact, they're weakening. Here's a chart of dollar yen. Now, if equities were due for another fall or another wobble, you would expect dollar yen would be weakening, which means yen is strengthening versus the dollar. Well, the opposite has actually happened. It looks as though this weakening trend that we've seen since the start of the year has come to an end, and it looks as though dollar yen is broken out of that downtrend and is moving higher. That bodes well for risk and therefore well for equities. And the other so-called safe haven trade, which is bonds, isn't really attracting much inflow either. This is the long, sorry, that's gold. This is the long bond, the US 30-year bond, and as you can see, that is weakening. So people not rushing into bonds, and in fact, bond yields are backing up. Bond yields are moving higher, and this is becoming a point of consternation again. This is the TLT ETF, similar sort of story there. couldn't retake the 50% retracement here from the high, and that has turned back down as well, which is causing a rise in yields. There's a lot of press, you've probably seen it, about what happens if the US 10-year Treasury hits 3% in yield. Some luminaries such as Gunlatch and Bill Gross are sort of predicting the end of the bond bull market if yields hit 3%. The fact is, so many people are now talking about this 3% figure that I tend to think absolutely nothing will happen if and when we do get there. But money is not running into safe havens like bonds and Japanese yen at the moment, which I think argues for further upside in equities. A couple of the sectors we've been watching lately. One was the real estate sector, where I had been expecting a breakout from this consolidation pattern, and nothing's really happened. We had a small breakout to the upside. It now looks like it wants to break to the downside. Real estate, as I've mentioned before, correlates closely with bonds, so if bonds weaken, real estate stocks and REITs will generally weaken. I bought a straddle on this, and it expired worthless. So that was, well, I mean, I sold it for pennies in the dollar. So that trade didn't work out. However, the other trade that worked out really well was the energy sector. You might remember I'd said that this has been chopping around. Now, oil has broken out. This broke out a few weeks ago and now looks to have formed a new uptrend. Oil has been trending up nicely, and I had been saying that the energy sector would probably follow oil eventually. And I think it had just been held low just by general share market volatility and share market weakness. And since that has abated a little bit, we've had a nice run up in the energy sector. I bought a straddle on this as well, and that made about 2.5 times. So that more than offset the loss on the real estate sector straddle. Gold still doing nothing. Gold is still chopping sideways in a fairly broad range. Still got my eye on it. If we do get a breakout to the upside, I do think gold will catch up to oil and a number of the other commodities that have started to move as well. Of course, we are in earnings season now in the US, and earnings season gets underway in earnest next week. Earnings season is always a bit of a quiet time for me from a trading perspective. I don't like playing the earnings lottery. I prefer to trade stocks whose earnings are still a few weeks away. And I'll also trade stocks who've just announced earnings. But when we're in the thick of earnings, I prefer not to trend trade, because news, earnings surprises will trump technicals every time. A number of the major banks have announced earnings. Been a bit of a mixed bag, and the financial sector really not doing much at all. This sort of action, wedged in between the moving averages, doesn't really inspire a lot of confidence. So it probably won't be financials that leads the market higher. It does look as though that will be down to tech again. Industrials are trading a little bit better. One of the big down and out stocks, GE, announced earnings that were surprisingly good, and that sort of kicked up. I really don't like to bottom fish stocks like this. I'd much rather buy stocks that are going up rather than stocks that are going down. It just makes life so much easier. Elsewhere, consumer staples are still trading really weak, and in fact, I talked about how this sector perhaps had found a bottom. Well, guess what? It's actually found a new bottom. So consumer staple stocks, they are still ripe for shorting. And if you see, that's probably the one sector at the moment where I would look at propulsion trades. Consumer staple stocks on the short side still look like good shorting candidates to me. Utilities really doing nothing, but I would expect they will roll over if bonds continue to sell off. And consumer discretionary looking okay. I'll be looking to take advantage of some strength in this sector to maybe look for some long trades in the consumer discretionary sector. Of course, Netflix reported, and Netflix is now at new all-time highs. Gotta love that stock. Anyway, that's about all I've got time for today, folks. I'm about to head to the airport, getting on a plane to Singapore this afternoon. Hope it helps. Good trading, everyone, and I'll catch you all next week. Thank you.